Welcome back from the break. I have let people in who have their names correctly changed to the format I required you or them. Well, there is one student who is still in the waiting room because she or he did not follow the rule, and so I kicked her out of the session. So I'm sorry, next time you please change your name according to the rules and I will let you in. So thank you very much. All right, now we are in the session and I'd like to share my screen with you. Just a minute. Yep. And here we are. All right, so, well, I let the guy in and hopefully he or she will change the name. Otherwise, I will put him out again. Okay. All right, so the next session is about consolidation theories and methods. And well, we are in a university, so we will have to look at the theories which are underlying our doing. So in consolidation, there are basically two big theories that can guide the consolidation of financial statements. So when you look at it from an economical point of view, well, the consolidated financial statements present the financial position and the results of the operation for a parent, which is the controlling entity, and one or more subsidiaries, which are the controlled entities. And that sentence is very important, as if, and I put a stress on it, as if the individual entities were actually one single entity. So we have a group and we look at the group as if that group was one single entity, although in reality, it's not. The group consists of many independent companies that are individually located in several cities in this world, and they have their own constitution by law. So they are, practically speaking, there are different companies, but they are all included in one group, and therefore we look at the group as if, and that is essential, as if it was one single entity. So what is the basic theory behind that? Well, the basic theory is that we have the interest theory and we have the unity theory. Well, when you look at the interest theory, the consolidated financial statements are set up from the view of the parent, because the parent is controlling the group. So when you look at the non-controlling interest part, that is not considered to be equity, it is considered to be debt, because it's not belonging to the group, and therefore the equity of the shareholders, which are belong to the non-controlling interest, they are considered from the parent's perspective as a debt. Because in the end, when you sell all the items, then the last that you pay would be the part to the non-controlling interest, and that from the perspective of the parent is a debt. When you look at the unity theory, well, then the consolidated financial statements are set up from the view of all shareholders. So the controlling shareholders and the non-controlling shareholders. So the non-controlling interest is considered to be equity. It's equity of the shareholders, which is put into the company. And well, in the end, that is the equity that has to be paid back to the shareholders, but that's equity and not a debt. So you see that from the theory, it may be a difference whether you have a group which consists of shareholders and non-controlling shareholders, so controlling shareholders and non-controlling shareholders. But when you look at the equity from the perspective of all shareholders, then there might not be a difference. So the question now is, which theory is IFRS following? And well, I think they are following both. And that is sometimes confusing. But for instance, when you look at the theory, when you look at the interest theory, which is this one, so the non-controlling interest is considered to be a debt. Well, when you look at the interest theory and look at the quota consolidation, we don't know what it is, but let me just explain that to you. Quota consolidation means that that part that goes to the controlling shareholders will be shown by them, and the non-controlling asset, or the assets that are belonging to the non-controlling interests go to those non-controlling interests. So that would be the principle of a quota consolidation. So basically you split the consolidation, and if a parent has, for instance, 70%, and you would follow the quota consolidation, which is a theoretical consolidation method, then maybe you would split 70% to the controlling shareholders and 30% to the non-controlling shareholders. That would be the idea of the interest theory. When you have the book value method, well, it's also part of the interest theory. But when you go to the fair value method, so each time you acquire a new company and you value the assets and liabilities as with a fair value, then of course that is following the unity theory. Same thing for the full consolidation. In contrast to the quota consolidation, if you consolidate everything with the group that has the majority, then you would also consolidate those assets and liabilities, or the part of those assets and liabilities that the group is not holding. So you have to show a minority interest as a debt. So that is following the unit theory here. The full goodwill method, and also the fresh start method, which is not there, which is just a theory. It's not in IFRS. Fresh start method would mean that whenever you acquire a company, you not only have to value that company at fair value, but you also have to value your own assets and liabilities of the parent, and also of the other companies. But in practice, IFRS does not allow this method. So you can see, and I don't want to go really into the details here. There are two main consolidation theories, and that is what you should take away from that slide. There is the interest theory, there is the unity theory, and in practice, IFRS follows both theories, and it will pick and choose for various answers. It will pick the theory that better explains the outcome. So yeah, I think that is enough for theory. So what does that mean for our consolidation in IFRS? Well, the consolidation method depends on the type of investment. So once you have correctly categorized your investment, your investee, then you know which consolidation method you should use for consolidation. So let's look at a subsidiary. We know that a subsidiary is controlled by the parent. So the investor is the parent of this subsidiary. And well, in that case, we will use the full consolidation method. So I will explain how that works later, but you should know that full consolidation means all the assets and all the liabilities of the subsidiary will go into the group accounts, no matter what percentage the investor is really holding. So let's assume this is clear. If the investor holds 100% of the subsidiary, it's clear that all of the assets and all of the liabilities should go into the consolidated financial statements, so into the group accounts. But if you have 60%, well, it's not so clear why all the assets and all the liabilities will go into the group accounts. And but that is what the full consolidation method requires. All the assets, all the liabilities go into the group accounts, although the investor is not holding 100%. And the difference, well, the difference is, can you think about the difference? What is the difference? If you don't hold 100% of a company, but you put all the assets and liabilities into your group accounts, well, the difference is the non-controlling investors, right? The non-controlling shares, the NCI, non-controlling interests. Okay, so that's, if you have a subsidiary, you use the full consolidation method, no matter what percentage you use. So don't use the quota consolidation on a 60% subsidiary. That's wrong. Because whenever IFRS 10 says whenever you are a parent of a subsidiary, no matter what is the percentage you have the power over, you use the full consolidation method. Now, when the investor is holding 20 to 50%, we assume that this is an associate. And when we have an associate, we will use the equity method. I will show to you what that is. Basically, it is a one-line consolidation method. So we will not put all the assets and not all the liabilities into the group accounts. We will only show that investment in one line. But what we do is we will account for the goodwill that is allocated to the associate, because also when you buy an associate, there might be a price that is more than what you get in terms of net assets. Okay, so that's the equity method. When we have an investment, well, that's the easiest part. We just leave that investment, which is shown in the single financial statements of the investor, because the investor has acquired that investee, and just include it as one asset in the group accounts. So it will just move like all the other assets from the single financial statements to the group accounts, and you will include that as one asset. So there is no consolidation when it comes to a normal investment. Here we speak about a full consolidation. Here we speak about equity consolidation or one line consolidation. And here there is clearly no consolidation. Now, when it comes to a joint venture, Well, to a joint transaction, what is it? A joint agreement. When you have a joint agreement, then you have to decide whether it is a joint venture or it is a joint operation. So when the joint venturers have only access to the net assets, then we have to consolidate the joint venture using the equity method. That is one line consolidation, like as if it was an associate. So the 50% is consolidated using the equity method when the joint arrangement is a joint venture. So the venturers have only access to the net assets. If they have access to the to specific assets like the pipeline, the gas pipeline, and the power plant, then we're talking about a joint operation. And then you have to use the quota consolidation. So basically, this is the full consolidation. And the company that is controlling the gas pipeline, they will consolidate the pipeline and the associated liabilities, and the other joint operator will consolidate, will put the power plant assets and the associated liabilities into the group accounts. So here, when you have a joint operation, a joint arrangement, then it depends whether it is a joint venture or a joint operation. In the joint venture case, you take the equity method. In the joint operation case, you take the quota consolidation. Okay. Well, that's all there is. It's that easy. Okay, so what do? You first have to find out what about the group companies. We did that already. So is it a subsidiary? Is it an associate? Is it a normal investment? Or is it a joint arrangement? And then the consolidation method will follow the type of investment. So this is just something you should print out, hang over your bed, and look at every evening. So you will easily identify the method that you will use when you have a certain type of investment. Okay. I'm still struggling with one of you. One of you did not change his or her name. So I'm sorry. Huang V, please change. Okay. He or she did it. Thank you very much. Otherwise, I would have thrown you out of the class. I'm very sorry to do that, but you helped me a lot because I can easily identify and give you some points. If not, then I have to seek in the list, and that's please help me in managing the course. All right, so thank you very much. And well, we can now go on in our slides. Here, another means of showing how that would be identified, how the methods of consolidation would be identified. You have the investment type. We already spoke about that. A subsidiary is a company that is controlled by another investor, typically more than 50%, or by other means. That could be a contract. And if you have a subsidiary, then the method of consolidation is the full consolidation. All assets and all liabilities of that subsidiary are included, together with the assets and liabilities of the parent in the group's financial statements. So that is a global consolidation or a global integration, how it is also called in practice. Now, if you have an associate, well, that company is not controlled, as we know. The investor has a significant influence, and the investor will participate in financial and operating decisions. Typically, when we see voting shares between 20 and 50%, then we assume that this investment is an associate, and we have to use the equity method, also called one-line consolidation or two-line consolidation if goodwill is shown separately. So that is the method for associates. Well, the investment, a normal investment where the investor has no significant influence, well, that investment is just transferred from the single financial statements of the parent to the group accounts as one single asset, full stop. And when it is a joint arrangement, well, it depends. And it depends on whether it is a joint operation or a joint venture. In the joint operation case, we have a quota consolidation because the pipeline is operated by one operator and the power plant is operated by the other one. So they will get their share according to those assets that belong to the power plant or to the gas pipeline. They will get their share. And a joint venture is when the parties, the joint venturers, have the rights to the net assets. They do not have access to specific assets. So in that case, they will use the equity method, which is the same as this one. So we don't need to learn a new consolidation method. So what do we have? We have the full consolidation, all assets. We have the quota consolidation. So specific assets will go to the group accounts. Then we have the equity method, same thing here. And we have no method because there is no consolidation. So in the end, I think it will be a little bit easier to memorize those consolidation methods. All right, so when we now look at the case study, I think, well, we could do that in breakout rooms, but I think that is too easy. It's clear now we have to use the same facts and circumstances as in the previous case study, discuss which consolidation method has to be used for each entity. And I think that's clear. We have to use, and that is the solution, we have to use for the subsidiaries the full consolidation. That means entities B, C, D, E, F, G, H, till P are fully consolidated. So they will be put on a table and then cross-footed. So all the assets in one line will be added. All the liabilities in a line will be added. All the revenues in one line will be added, and so on. So subsidiaries, full consolidation. Associates, well, they have to be valued with the equity method, and then they will be shown in one line or in two lines if goodwill is, so one line including goodwill, or two lines if goodwill is shown separately. So both methods are there in practice. So entities J and M will be consolidated following the equity method. And then there is the joint arrangement. So it depends on what they are. Is it a joint control, or is it a joint venture or a joint operation? So I think I have to change that one. So it should read joint venture or joint operation. So it depends on which one. Either you take the equity method or the quota consolidation. And well, there is one normal investment, which is Q, and that one has to be shown in the financial statements of the group as one single asset. So there is no consolidation of that entity. Questions? No, I think that's clear. So the consolidation is dependent on the type of investment. So we have to find out which investment, and then we know which method of consolidation. All right, so let's have a look at the practice. So before going deeper into the theory, we will first have a look at the Daimler annual report, and then the Wiener Milk annual report, and get some insight into practice. So we will compare pages 162 and 163 in the Daimler financial statements, and we will compare 153 plus 154, the principles of consolidation in Wiener Milk. And well, no wonder they are pretty much the same. So how can I share my screen? I think I take this one. Yes, it works. So pages 162, and let me see. So 162, I key that in, and hopefully it goes to page 162. Yes, it does. So what can we see if we see something? Okay, I try to make it a little bit bigger so that you can see something. Oh. Okay, here we are. So we are in the notes to the financial statements. This is page 161, so we have to go to the next page, and it tells us the principles of consolidation of the Daimler Group. So the consolidated financial statements include the financial statements of Daimler AG, which is the parent, and the financial statements of all subsidiaries, including structured entities. So a structured entity is special purpose entities where they maybe only have 5 or 10%, so they don't have the majority of voting rights. But where those structured entities are directly or indirectly controlled by the parent, by Daimler. So also structured entities are included in the financial statements of the group. Control exists if the parent company has the power of decision over a subsidiary based on voting rights or other rights, if it participates in positive and negative variable returns from a subsidiary, and if it can affect these returns by its power of or decision. You see, they have described that in a brilliant way, what the IFRS or the board, the IASB, was putting in very complicated words. And so I think we understand that very well now, what they describe, what are the principles of consolidation. So structured entities which are controlled also have to be consolidated, yes. Accordingly, the assets and liabilities are recognized in the consolidated statement of financial position. Yes, and I think that is clear. What comes next? Structured entities are entities which have been designed so that voting or similar rights are not relevant in deciding who controls the entity. This is the case, for example, if voting rights relate to administrative tasks only, and the relevant activities are directed by means of contractual arrangements. Okay, that sounds familiar to us. Then the financial statements of consolidated subsidiaries, which are included in the consolidated financial statements, are generally prepared as of the reporting date of the consolidated financial statements. The financial statements of Daimler AG and its subsidiaries included are prepared using uniform recognition and measurement principles. All intra-group assets and liabilities, equity, income and expenses, as well as cash flows from transactions between consolidated entities are entirely eliminated in the course of the consolidation process. We will have a look at that a little bit later. Then the business combinations are accounted for using the purchase method or acquisition method, same thing. That is also something we will look into. All right, I think we now have an understanding of how Daimler AG is consolidating the group accounts. So let's look at Wienermilch. Oops, sorry, I closed the window. Now we will go back to my slide 51. Okay, now we will look into the Wienermilch annual statement 2020. And I will share my screen. Okay, that works. So now we have to find the principles of consolidation, which are on page 153. So let's have, give me an error. So maybe we have to go there manually. We know that there are the notes. We already saw that. Okay, here we have this consolidated financial statements under VAS. So here we have the notes to the consolidated financial statements. And we know already that this is VAS, as it says here. Financial statements, notes to the financial statements under VAS. So the notes relate to VAS only. And on page, what was it, 153? 153, or is it 151, 153? We have the basis of consolidation, okay? Can you read that? Probably not. So I will make it a little bit larger for you. By the way, you have that PDF file in your e-learning system. So you can go back and look at pages 153, 154. So here we have the explanation under VAS, what is a subsidiary? Subsidiaries are those entities in which the group has control over the financial and operating policies, generally evidenced by holding more than half of the voting rights, so more than 50% of the voting rights. In assessing control, exercisable potential voting rights are taken into account. The financial statements of the subsidiaries are included in the consolidated financial statements from the date that control commences until the date that control ceases. So basically, we have an understanding. It's not a big difference, but my question here is, what about structured entities? Are they included under VAS or not? So we have to ask the auditor, and if they are allowed to talk to us, then they could tell us whether structured entities are included or not. of course the liabilities of the structured entities, which is or might be a problem. So we don't know. All right, so but basically when you look at the VAS notes, they look similar to what would be expected under IFRS. Of course, if there are differences, then this will not be very obvious from what you read, but what you not read, because what is not there could be a difference, right? So, and that causes the problems in practice. So the investor is not sure whether whether there is a big difference to IFRS, because there are no notes available for the IFRS financial statements, which are attached to these VAS numbers, but not all the information that is required by IFRS is given. Well, at the moment, they don't have to. Yeah, we are still in the preparing phase. So I think it's a good exercise to have those numbers, but we also would like to see the explanations, and then would be able to find out whether there are differences in the numbers when looking at the explanations. Okay, so that's I think that's it. So they also speak about non-controlling interests. They speak about associates. So they also look at companies that have a significant influence. So you can see that VAS is not out of the world of IFRS. So there are some principles already used in VAS that come from the international standards like US GAAP or IFRS. But of course, it's not a one-to-one thing. Yeah, okay. I think we can go back now, and I will just go back to my slide so that you can, yes, you can see this one. Okay, great. So what we did, we looked at the principles of consolidation in the Daimler AG under IFRS and in Wiener Milk under VAS. And we saw that there are similarities, but I think in detail, it is, you cannot compare it because the details are not there. All right, then we have done this, and now we will go and have a look at a very simple example. So Ghana is the parent that acquires Accra, which will be the subsidiary. And that simple example shall demonstrate how the consolidation process works in principles. So let's look at the next slide. Here are the facts and circumstances. So on the last day, to make it easier, Ghana acquires all the shares of Accra. So that is also easy because we have full control, 100% of the voting rights. The purchase price was $300 or $300 million. Yeah, you are used to just omit the zeros, so I think we can live with that. And then that's also, just to keep it simple, there were no hidden reserves. So normally the book values do not represent the fair values at the time of acquisition. But in this case, all the assets and liabilities recorded in the balance sheet of Accra represent the fair values as of the acquisition date. So normally you have the book value and you have differences to the fair values at the time of acquisition. In this case, to keep it simple, we don't have that. And then the next slide shows the two separate statements of financial position of the two companies, Ghana and Accra, just before the acquisition. Okay, and then I think we should try this in groups. Please make the necessary entries in the separate statement of financial position of the parent of Ghana to reflect the acquisition. So we're first going to the separate financial statement of the parent company, and we'll just reflect this acquisition. And then in the next step, we will have to prepare the consolidated financial statements for the group. Okay, so let's look at these two balance sheets. And I have only put here the balance sheet. The income statement is just the same principle, and we will look at income statements later. So just to keep it simple, we only look at the balance sheet, but of course, in real life, we would also look at the income statement, okay? All right, so please make sure that you understand that these two balance sheets are from the separate financial statements. They have nothing to do with the group accounts so far. Okay, so we are not seeing the group accounts here. We just see two statements of financial position, and they are made of, they are set up by the companies. So Ghana is setting up their balance sheet. So that is, P means parent. So this is the balance sheet of the parent. You show, we have the assets here. And here we have the liabilities and the equity. So 700 equals 700, which is good. Yeah? So we have a real balance. I use the form of showing assets with a plus and liabilities with a minus. So just keep that in mind, not to be confused. You could do it differently, but you have to do it permanently in this method you select. I chose this one just to make life for me easier, because when I add in Excel, then I would subtract the liabilities when I add those cells. Okay. So, you know, I'm an auditor, I'm a control freak, and I control myself with that kind of a question here. Is the sum of the balance sheet equal to the liability and equity side? So if yes, put an okay in there. And if there is a difference, please remind me with check. But can you please mute your microphone? That is getting a strange noise. Yes, thank you very much. All right, so this is the single financial statement of Ghana, and the same single financial statement for Accra is displayed on the right-hand side. Again, we have cash, we have assets of 600, and we have liabilities and equity of 600. So the control total says good, well done so far. Now, well, this is these are the two financial statements just in the second before the acquisition. So in Ghana, we don't see an investment so far, but Ghana has a lot of cash. Obviously, they will have to pay for the acquisition of Accra. And well, in this case, we have a net assets of 300, or 600 minus liabilities of 300 equals equity or net assets of 300. And well, that was the purchase price. Okay. So obviously there are no hidden reserves. The purchase price is at fair value, and all the other items are also at fair value. So when you look at inventory, that is the fair value of inventory, which can be obtained for the inventories. Non-current assets, tangible, so maybe this is land or buildings. So in that case, there are no hidden reserves in here. All right, so I will now put you in breakout sessions, and please, this is the separate statement of the parent, make the necessary entries into the separate statement of financial position of Ghana to reflect the acquisition of Accra. So I will put you now in breakout sessions, and then we will see what you're doing with this one. So welcome back from the from the breakout session. We looked at the separate financial statement of position for the parent, which is Ghana. And here is the suggested solution. You will see the last entries in the year of Ghana, and they just bought Accra as at the very last day in the period. So we will see the investment increasing by 300, which is the purchase price or the fair value, so to speak, of that investment. And they paid 300 out of the bank account. So the cash at bank is decreasing by that number. And that's all. So please look at the two separate financial statements now, because this is the changed one. So it shows an investment of 300 and the cash at bank, which is lower than it was before the acquisition. In this case, the investment, as it really shows the fair value of the of Accra, which was purchased at that date, those two numbers are identical. In practice, this is not very typical because most of the investments will include hidden reserves, which will not be shown in equity of the acquired company. And therefore, also no hidden reserves, no goodwill will be seen here. So the numbers are the same because of the simplified example, because there were no hidden reserves and no goodwill. So I just want to let you know that these two numbers in practice will not be the same in most of the times. This is just a result of the simplified example. All right, so we have, and I saw that many of you had that right. We have now two separate statements of financial position at the year end. And well, now it's our time to consolidate these. So how can we do that? Well, let's just analyze the situation. Well, Ghana is the parent of the company. It has acquired 100% of Accra, so it's controlling Accra completely. There is no minority because Ghana has acquired 100%. If they would have only acquired 90%, they would have a non-controlling interest of 10%. But in this case, there is no non-controlling interest because they have acquired 100%. So we refer to non-controlling interests as NCI, so there is no NCI in this case. And now we will start with the two separate financial statements of Ghana and Accra, so which is on the previous slide, which is slide 56. We will take these separate financial statements and then use that as a starting point for the consolidation. So what we do is we take all of the assets of the parent, all of the assets of the subsidiary, and put it into the group accounts, which is only one financial statements. So we combine these assets and liabilities as if it was one company and put it onto one balance sheet. So here is the form. Please use these. And I have seen that some of you already started, so they have a little bit of advantage from a timing aspect. But then make sure that you get it right. So please prepare the consolidated statement of financial position for the group. And as you can see, I have already put in Ghana, which is the parent. I have put in the heading for Accra. So just put in the right numbers here and then calculate a subtotal. And then we have to look what consolidation entries we do have to make to come to the end, which is the group account. All right, so I will stop recording. So welcome back from the breakout room. We were doing the Ghana case study, and well, you were required to prepare the consolidated financial statements for the group. So what did we do? Well, we first would enter the separate financial statements. So we used the column for the parent and for the subsidiary and filled in the numbers. The question here could be, well, which numbers do we take? Of course, the very last numbers, so that those numbers that include the acquisition of Accra, so the financial statements of Ghana should reflect that investment of 300, and the credit was the cash at bank, which decreased by that 300 to 200. Then we have to add those two columns. So we get a subtotal, just adding apples and bananas, or well, let's try to add apples and add bananas separately. So tangibles were added, 200. So 100 of tangibles, that could be land or machines or something like that. They come from Accra, and the other tangibles come from Ghana. So we have 200 here. Well, in investment is just a subtotal. Then we have current assets, 40 plus 200 equals 240, and so on. So you do that with the ordinary share capital, just add it like apples and bananas, and you then show an equity of 700 in the subtotal column, and you add the non-current liabilities, which add up like this. So you should have control over these totals that agree. Now, when you look at the subtotal, is that the final group account? Well, or what does not look right? Well, when you look at the subtotal, then you will notice that you have an investment in Accra shown in the group accounts, and you have all the assets and liabilities. You have put that into 200. The 200 is included in the 240, the 100 in the 160, and also the net equity of 300 is included in this subtotal. So that is not correct, because you basically have the net assets twice in the subtotal. So what you will show here is an investment, which is not okay, because the group does not have an investment. the group consists of all the assets and liabilities from this acquisition. So the investment should not be shown. So this 300 has to be eliminated. It's double. You have the investment as an asset, and you have all the other tangibles and current assets of Accra included in these numbers. So they have to be adjusted, eliminated. What else is looking wrong? Well, when you look at the equity, just by buying something, will you be richer than before? No, you have just changed the investment. So you have changed cash for investment, right? So you're not richer, but equity assumes that you are now richer when you're adding these the subsidiary. That is not true. So you should only have the equity of the parent in the group account. And therefore, the equity of the Accra has to be eliminated. So basically what you do is you have some consolidation entries. You will credit the investment by 300 and then debit the ordinary share capital of the subsidiary, which is 100, and then debit retained earnings of 200. So in the end, you have debited the equity by 300. I have just not put in the subtotals to make it more visible. In the practice, you will, of course, have some subtotals here. So I just made that a little bit easier for you to read. So what we did is we consolidated the two companies which are shown in one group accounts. We eliminated the investment and we eliminated the ordinary share capital and retained earnings. So that is called capital consolidation. So we will eliminate the investment of a fully consolidated entity against the equity of that company. So in the end, to check whether you're right, you should look at equity of your group accounts, and they should be the same as of the parent. So if that is not equal, then you have made a mistake. Okay. And in the end, you should not show an investment of fully consolidated companies, because they are included in all the other assets and in all the other liabilities. Okay, so here we have the group accounts, and that is the process of consolidation. What you do is you just put the you put the parents and all the subsidiary accounts side by side. So if you have 100 subsidiaries, this table will get rather long. Yeah, but I mean, in theory, we just stick to a few companies to make the process easier to understand. In practice, of course, this will be done by a computer, and the computer will then perform all the consolidation entries based on the accountant's instructions. And in the end, you will have the group accounts. All right, so please make sure that in the group accounts, you do not have the investment anymore. So you have that investment of Accra sitting here, so that will go out. And you don't have the equity of the subsidiaries, that also should go out. And in the end, you will show the group accounts for this. So why are group accounts more meaningful than separate accounts? So please have a look at the theory, and I think we will close the session for today because it's 7 o'clock. So we will go on from here tomorrow. So why is the subtotal 300? Well, it's the addition of 100 and 200 is 300. So we debit in total 300 and we credit in total 300. Hope that explains your questions. Yeah, there's an interesting question. Whether debits and credits are always equal. Yes, they should be equal, otherwise you make a mistake. We have a system of double entries, and the sum of all debits should be the sum of all credits. Okay. So I think I have asked, I have answered all your questions. So thank you very much for participating. It was a pleasure for me to see you all working very actively. I have made notes that you participated. For the one guy who was sent twice to the waiting room, please do not expect that you get a good evaluation from me for today. So please tomorrow be active. When I see you in the main room when all the others are working, then I assume you're not participating, and I will send you to the waiting room, and that has some consequences also. So thank you very much. The others participated well, so thank you very much for that one. And see you tomorrow at 1:30 your time. So bye-bye for now.